Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And joining me on the show today is Tom Loucks, an active lender of ours here at Fund That Flip. Tom has invested in nearly 40 projects dating back to March 2018, so just over 2 years. Tom has also been making some investments over the past couple of weeks as we've all been working our way through the COVID pandemic. So we thought we'd invite him onto the show to share his perspective. So with that, welcome to the show, Tom.
Thanks, Matt.
Great to have you. So maybe before we jump into, how you're thinking about investing generally during this time, maybe just give us a little bit of background on you, who you are, and kind of how you got your way into investing in real estate.
Okay. Well, it starts off, I played tennis. Tennis was my whole life. I played tennis through college, played for UCLA, started teaching after that. I guess the good thing about that is you start off with an income right away. It's not like being a doctor or something where you go to school forever. And so I was a good saver, and along with my wife, and we obviously started investing, and so that gave me some capital to work with. I was still playing some tournaments, but not too many at that point. And then when my kids came along, I really worked with them. They were really good players. In fact, I won the National Senior Father-Son with my oldest one last year, and so hopefully my younger son will be able to even do that in the future as well. So then, when I started off like most people, when you think real estate, you buy, and I was buying and renting, and that led to eventually finding out about lending. I hadn't done really any hard money lending. I started lending on some projects for people that did well and got comfortable doing that. Took a few lumps probably in 2008, like a lot of people, and learned a few things there. Mm-hmm. And then when the funding aspect came along, I started getting involved in that. And and basically, I feel strange to say I'm retired, but because I feel like I'm busy between investing and I'm active in my church. I'm an elder and lead a life group, and that's a big part of my life. And so that that's been a blessing for me. So, and now I'm able to feel like I'm helping other people. My wife works for her dad, who wrote a book called The Business of Horses, and she spends her time in the horse world, and also there's an outreach there that we're helping. She does things with veterans. My passion is with kids. We're going to be doing a thing with kids, and we've done some in the U.S. and Guatemala. We're doing one in Brazil that we're working on now, and so that pretty much is what I do. Got it.
Very cool. So tennis, still playing, did some coaching. Were you professional at any point, or did you go down that route, or right out of school?
I did. I played a little bit. I played the qualifying at Wimbledon. Last time I told that story, though, I have to be careful. This is probably God humbling me. So I went into a store when I was waiting for my son. Shows how many great tennis players are. I'm in Orange County, live down here. So I was walk in a store. A woman comes up, a sporting goods store. She said, "Can I help you?" And I said, "Sure. Where's the tennis section?" And she said, "Oh, well, I'll take you over to it. Are you a tennis player?" And I said, "Well, yeah, I did play. I played in qualifying at Wimbledon." And she said, "No, really, my dad won that tournament 8 times." And so I paused and thought, wait, she didn't hear what I said. I mean, it's crazy. And I said, "Oh, really?" And I was thinking, no way. And I said, "Well, who's your dad?" And Roy Emerson. So was Australian that won Wimbledon several times. So anyway, so that was, I'm decided I'd be careful when I say where I
so that's pretty cool.
I've done a lot more than you have, but yeah. So yeah. I had a brief stint playing some professional tennis, but
nonetheless, that's cool. So tennis into real estate, first as an operator and then into a lender. I had a similar path. I'd flipped some houses and learned of the lending space and thought, man, this is, I don't like swinging hammers or picking paint colors or doing all of the other stuff. Lending seems a lot more interesting to me. So that's interesting. You kind of found a similar path, and learned right before this that, yeah, your wife's father is the Horse Whisperer, which was a book that I read when I was a kid. So it's a really, really cool story. Very cool story.
Yeah. And she has a podcast, Horsemanship Radio. So I'm used to hearing podcasts, less being on them, but
pod listener to podcaster. You can add it to the resume. Very cool. Awesome. So let's move into a little bit about kind of how you think about investing. So it sounds like you've been investing on platforms, across the space for some time now. And before that, you were doing some of your own direct investing. I get asked the question a lot from investors, like, what's your best investment, right? They call me up or they call our team up and say, hey, I want to invest in the platform. What's your best investment? And I kind of believe best is somewhat subjective, right? So what we try to do is point people to some different things to pay attention to, like loan to values and loan to cost and credit scores and geographies and relevant borrower experience. I'd be interested from your perspective as someone who's done a decent amount of this across a number of different platforms. What are you dialing into when you're choosing an investment or not to invest in?
Yeah, it's a good question. It's funny, back before before even the real estate, I was, when I first started investing, I was married back in 1980, and stock market was very, cheap if you look at just on financial on a relative basis, and partly that was because interest rates were through the roof. But anyway, so I did that for a long time. And then as the market, I felt got expensive, that's when I looked more towards getting either real estate or getting a yield in real estate. And so then in the early 2000s, then I was into kind of a lower, I would call lower priced houses that produced a great rental income, but they ended up being, it's quite a bit of work. I would say more manager heavy. But I felt like less risk, although I really think taking a few bruises in the 08, 09 area, I think you could see sometimes how the real lower end sometimes gets hurt more than you would think. I was thinking, well, the high end, of course, that's really where all the pain is going to be, but it really didn't end up always being that way. So it kind of it influenced how I look even at the platform, where I will, not that I'm searching for super expensive places necessarily, but I am less concerned about the actual price as much as I am the loan to value, the neighborhood. I'll look at Trulia and look at the school scores sometimes, and I will, go on Google Maps and look at the area. I did listen to your podcast of the guy in Columbus, and I have done several things with him. I have to be, if I'm comfortable with the lender, and that's, when you source your own deals and you meet the people, and if you get a relationship, then obviously you have a little bit of an edge. When you're on a platform, you're reading about them and you can look at their track record, which is helpful. But then the podcast is actually even another level better, where you can actually hear kind of the guy's philosophy, and you give your gut feel on comfort. But I know that has had some influence on what I'm looking at the deals. So
got it. So podcasts have been helpful. That's good to know. And for those of you that maybe haven't caught it, we shot one with Mark Inks, who's an operator in Columbus, who's got a number of projects with us right now. And we just did another one recently. I don't know if you caught this one, Tom, with Jason Babin out of Jacksonville, Florida area. We got a project with him going too, former NFL player, which was a fun podcast to shoot. So interesting. And one of the things I'm curious about is, you were active in the space in 2008. So what were some of the lessons you learned, in 08 that have kind of informed your go forward strategy? You mentioned one around, maybe the lower end of the market, and anything else there that kind of are maybe salient takeaways for folks that are listening?
Well, I think that I would say how much cash somebody puts in the deal. I was probably a little bit too lenient there. And also the part you just can't predict. It's I guess I'll probably butcher this, but it's the Warren Buffett statement of, you don't really know who's wearing the swim trunks till the tide goes out. And
Yeah.
so even if, somebody had a great track record, it really tested them when it got difficult. So I think we'll all learn, it's just the way it works. Whenever there's any kind of a crisis, you kind of figure out the skill level of the people that you're dealing with.
Yeah, for sure. So given that you went through kind of the 2008 and were actively in the space, and now we're in, I like to give the date on these because things are moving so quickly these days. It's April 28th. Given that we're in the midst of a new, very different, obviously, but a new kind of economic impact with the COVID pandemic, with the shutdowns and everything else going on, do you see any parallels in how are you thinking about investing, or is your strategy involved or changed kind of over the last month since all of this has really started to settle in?
Well, one thing, because I have a certain comfort level in the stock market, it did get interesting when, mid-March, when it was just that downdraft. I thought, well, I better keep some firepower, because if things are just given away, I might look a little bit more outside of the real estate area, because I had been doing just primarily the lending. I hadn't done really anything else. And so I did find a few things, but then now as we're speaking, I feel like there's another disconnect happening where you feel like on the ground reality is pretty tough. I haven't been outside of my house hardly for the last 3 weeks. And yet, got the stock market zooming ahead. So I'm not as positive on that, and recently made more investments on the platform because I think there may be another downdraft, but that's something it's hard to predict. And I'm always keeping some cash available to take advantage of things. And maybe there's obviously different maturities dates on your platform. So that's another thing to look at. But did I answer your question?
Yeah. Just, I guess maybe to follow up on that, do you see any parallels between this one and 2008? Or do you think, obviously housing was a big part of 2008. What do you think happens this go around, if anything?
Yeah, I think obviously real estate was more weak in 2008 with just how loose the lending standards were. So there was going to be a lot more cratering and a lot of people that should never have, been able to buy, that were able to just get loans. So we don't have that problem. So it's more of a function, I think, of it's completely different. So I think it's, as long as qualified people, now it's really the question of, can qualified people that actually have solid incomes when they could work, and are they going to be able to get a loan? Is the machine going to keep functioning?
Yeah.
So that's why I'm more optimistic than I was. I think this will not be. I think this will be this could be a long slog, but I don't think it's going to have the downdraft.
Yeah. Fundamentals of housing going into this, I think, were very different from all the data that we see. We had more of a supply problem in housing going into this. Not enough supply for people that did want to buy homes. It'll be interesting to see what happens on the other side of that. Obviously, I think the demand equation may be changed with the unemployment. But you could see additional constraints around supply with people that maybe were thinking about selling their house that aren't now. So a lot of moving parts. I think with the amount of liquidity the government's pumping into the system, hopefully we can, to your point, keep the machine working. People can get back to work and paying their mortgages and rents to keep the machine working. But time will tell. All right, cool. So moving us on here a little bit. So we talk a little bit about some of the things you're looking at on a deal basis. As far as like constructing a portfolio. So you've got, I think 30 some active investments right now. We like to say, ideally minimum 10 investments, ideally 20 investments, just to build out, a diverse enough portfolio. Do you have anything that you kind of think about when you're when you're constructing your portfolio around, amount of exposure to any one borrower or geo, or maybe just talk to us through that a little bit.
It does cross your mind. You think, oh, this guy's got a good track record, and I'll just do several deals with him. And then you do think, well, what happens if something happens to this guy? And then you're too loaded up on one person. But so obviously that's part of the consideration. Part of it is, when I first, before I even Fund That Flip, when I was doing deals with other companies in the platform, one thing I learned was that the maturity date wasn't held to quite as much as I expected. And I feel like you guys do a much better job of actually, when that, you take that maturity date seriously. You have to extend sometimes, just like everybody has to, even if you did your own private deals. There's things that happen, especially with today's current environment, or maybe permits slow down, or there's some issue that the person's dealing with a little bit outside of their control, and they're good at communicating, and so you work with them. But I did find, originally I was kind of surprised how, we're just extending it, when I felt like it was a person really hustling, and I realized, wow, I can't really look at that date and expect to get my money out. So I have to be a little more careful with how long stuff could drag out. So I do look at that. I know you guys have your series offerings which I think is another good way to diversify, that has a set date. But as long as you have different length of time, it tends to work out pretty well. And I've had a good experience with the payoff times. So
that's one of the things you're looking at is we call it laddering maturity dates, to say, hey, you've got one coming due in 9 months and 10 months and 11 months, 12 months, 8 months. So you start to build a little bit of liquidity in an otherwise illiquid asset, something that sounds like you're paying attention to.
Yeah.
That makes sense.
Yeah. And I look at the photos, and I'm following I've even looked back at how the guy did timeline on past projects before I invested, and see if he was able to finish time. So there's definitely, you can spend quite a bit of time researching on your site and looking at people's track record.
Yeah. One of the things we try to do is provide as much transparency as possible, for sure. Extensions are an interesting thing. They kind of cut both ways. In one regard, they can produce additional income through extension fees. We like to use them because they provide we like to use the maturity date because it provides a check-in point for, do something or don't, to protect risk. So we try to keep we try to match our initial maturity date up as closely as we can to what we think the project actually needs. So that we can pay people back when they expect, but also have a pretty good check-in for, if we need to create some incentive for the borrower to get out of it, we've got that maturity date to lean into. So that's interesting.
The best thing you guys do, and this started back, I'll give Lena a plug, who was the very first person I ever spoke to, I think, at your company. I had a question about a certain project, and then, or whether I would even do this project, or I had a question, and she put me in touch with John, and I think it was in Pittsburgh, and he had some background there. And so I got way more insight than I had on other platforms. That was the communication part was really good, which then extends into, I'm not used, you guys do a much better job of instead of just waiting for the maturity date, way ahead, you'll say, hey, you haven't even taken a draw yet. What's happening? Or so I'm less surprised even if you do go past the maturity date. Is something I was probably aware of 3 months before that. It was where you warned the people, like, hey, it could be now with the COVID issue, but you might just be, hey, this person's going to need, we can tell he's going to need 3 more months or wait. So it's less of a surprise, which is nice, because just when you don't know and have really any idea what's happening on other platforms, sometimes then it's more difficult for me to know to make any forecasts. So I really like the communication. You guys do a great job of that.
Very good. Appreciate it. Shout out to Lena. She's on maternity leave now. She had her.
That's right.
I think she's coming back in a couple of weeks. We're excited to have her back, but new baby. Yes. Okay, good. That's it's good feedback here. I'm learning some stuff. We'll have to keep up the podcasts with both borrowers and maybe get John back on here to talk through some more deals and some of the different geos we operate in. Sounds like that may be useful for some folks. All right, cool. So Tom, I'm going to get you out of here on this. If you can look into your crystal ball, and we talked about it a little bit, what do you think? When do you think we start to come out of this, and what do you think it looks like on the other side? Are we in a 12 to 18, 24 month kind of recession? Do you think we bounce back? There's been talk about the V recovery, the U recovery. What's your best guess based on, kind of your experience and what you're paying attention to?
I don't think we're in going to be in a V recovery. I think that investments like Fund That Flip, when enough money's put down, you're a little bit less, at least for me, as long as the cogs of the wheel of the machine doesn't fall apart, it doesn't really matter that much to me how quick the recovery is, because I feel like the borrower will be able to work through it. I think it's tougher in the equity markets to know what's going to happen, and I don't. I think this is going to be more of a 12 to 24 month issue to get. It was such a shock to the economy to kind of get it functioning. Are restaurants really going to? How are they going to? And travel. How is it even going to come back? I'd be shocked if that came back real quick. But and is it going to change? They have to change seating and how they do business and everything else. It's going to have quite a few effects. Which I realize can trickle down into everything. But if the borrowers are making wise moves and reflecting that in their purchases, and they're able to, and they most of these people you're dealing with, on the borrowing side, they have teams that they're comfortable with. They know their business. And, it might affect their margin, or they're just going to have to get a better margin going in. But I don't know if, I'm hopeful that as a lender, it's not going to, I may read the headlines in the paper, but it won't really affect me too much.
Yeah. Got a little bit of cushion built in, hopefully, to how we've structured the loans. Yeah. It's a big machine to get moving as fast as it shut down. So I'm starting to feel a little bit more in your camp of, I think we'll start to see some bounce back, but I think it is going to take some time for businesses to spin back up and be generating revenue, to be reinvesting in their companies and everything else. So I think the word slog was mentioned at some point, either on this conversation or the one we had previously. I think we got a little bit of a slog ahead of us still.
Yeah.
Well, listen, Tom, this was great. Really appreciate you taking some time to share some of your perspectives and insights. Really appreciate the time. Super insightful.
Yeah, you have a great company. I appreciate being on the podcast. Thanks.
Thanks so much. And thank you all for listening. Feedback is super helpful and it makes us better. So if you have any ideas, suggestions, or questions, please email us at investorrelations@fundthatflip.com. Otherwise, be sure to check out our blog also at fundthatflip.com for more content on, like this, as well as we mentioned here, some podcasts that we have with borrowers, as well as we're posting a decent amount of content around the COVID crisis and how we're responding to it and what we're seeing generally in the market. So a lot of good stuff coming out on the blog now. Check that out. Otherwise, look forward to having you join us next time. Thanks again for listening. Until next time, this is Matt signing off.